Hey everyone, welcome back to Web3 Daily. Today's market has been absolutely wild, both exciting and nerve-wracking. Last night when I was watching the charts, I saw Ethereum break through $4,200, and my first thought was, whoa, is this thing about to take off? Honestly, I haven't seen Ethereum this aggressive in ages, first time hitting this level since December 2021. You know what? In the past 24 hours, Ethereum jumped almost 6%, and the weekly gain is close to 20%. This kind of rally, I gotta say, makes me a bit skeptical. Bitcoin, on the other hand, is playing it cool, consolidating around $117,000 with just a tiny gain of 0.45%. But I actually think this is a good thing. Look, Bitcoin's market dominance dropped from 64% to around 58%. What does that tell you? Money's rotating, flowing from Bitcoin into Ethereum and other altcoins. Personally, I think this might be signaling the start of altcoin season. Other coins are pumping too. XRP up 6.15%, Solana up 2.87%, BNB also up nearly 2%. The overall market sentiment, how do I put it? Feels like pent-up energy finally exploding. But hey, I gotta remind you, markets are risky, so keep your positions in check. Speaking of Ethereum breaking through $4,200, I really need to talk to you guys about this. What happened last night was absolutely insane. Over $200 million in Ethereum short positions got liquidated in the past 24 hours. 200 million, folks.
Those shorts are probably kicking themselves right now. The discussion on Twitter was absolutely explosive. Over 25,000 tweets in just 2 hours, with around 60,000 people jumping in.
The most interesting part is when I look through the sentiment of these tweets, 53% were bullish, while bearish sentiment was less than 9%. This kind of one-sided sentiment, honestly, I rarely see. Social media sentiment score hit 86 out of 100. That's basically extreme optimism. But what really makes me think this time is different is the institutional moves. You might not know this, but July's Ethereum ETF inflows exceeded $5.1 billion, with cumulative inflows at $9.6 billion. BlackRock's ETH fund alone had $7.27 billion in single-day inflows, and it's been net positive for 12 straight weeks. Last time I saw institutional entry at this scale was during the previous bull run. Even crazier, over $1.62 billion worth of Ethereum has been added to corporate balance sheets. What does this mean? It means these companies are treating Ethereum like a reserve asset, same as holding cash or gold. Several companies, including Cosmos Health, have announced major Ethereum treasury strategies. There's also the technical catalyst, the Pectra upgrade scheduled for Q4 2025. This upgrade will further enhance Ethereum's performance and scalability. Plus, with Layer 2 ecosystem developing rapidly, Arbitrum, Optimism, all maturing, the entire Ethereum infrastructure is getting more and more robust. My personal take, this breakout isn't just a technical bounce. Institutional money, technical upgrades, market sentiment, everything's resonating together. Sure, we might see a pullback short term, it's rising too fast. But a medium to long term, $5,000 might actually be achievable. Now let's talk about the first major news. Trump signed a historic executive order allowing 401k retirement accounts to invest in cryptocurrency. When this news came out, I was honestly stunned for a moment. We're talking about 401k here. American retirement accounts with a total size of around $9 trillion. Think about it. Even if just 1% of that money flows in, that's $90 billion. The executive order is crystal clear. 401 plans can invest in various alternative assets, including actively managed investment vehicles that hold digital assets. In plain English, Americans' retirement money can finally legally buy Bitcoin. I think this is huge. It's not just a policy relaxation. It's the highest level recognition of cryptocurrency as a legitimate investment asset. You know what? Retirement money is different from speculative capital. This money is typically held long-term, not buying today and selling tomorrow. This kind of stable money coming in really helps reduce market volatility. Some analysts are saying, after this policy is fully implemented, Bitcoin could rise 30 to 50% over the next 2 to 3 years. Personally, I think that estimate is conservative. Of course, there will be challenges in implementation. Retirement fund managers need to establish risk management systems. Investor education needs to catch up. Initially, It'll probably be mostly indirect investment through ETFs. Not many will buy coins directly, but regardless, this door is now open, and the money flow is just a matter of time. The second piece of news shocked me even more. Harvard University's Endowment Fund holds $1.16 billion in Bitcoin ETF. Harvard, folks, managing a $50 billion endowment, and now their Bitcoin ETF holdings exceed their gold allocation. When I saw this news, my first thought was, if even an institution as conservative as Harvard is buying Bitcoin big time, the market has really changed. You need to understand Harvard Management Company's CEO Narv Narvikar is famously conservative. When someone like this starts allocating to Bitcoin, what does it tell you? It tells you institutional investors now see Bitcoin as a necessary asset allocation, not some optional speculative instrument. And they've allocated 2.32%. That's actually not a small percentage. The key thing is the demonstration effect. The top 50 US university endowments together manage over $300 billion. If they all allocate at Harvard's percentage, that's $70 billion in potential demand. I bet Yale, Stanford, Princeton are all watching closely and will likely follow. Interestingly, Harvard chose to buy ETF rather than coins directly. That's actually smart. ETFs are simple to operate, have good compliance, convenient for auditing. For heavily regulated education funds, this is the safest approach. BlackRock's IBIT fund has already attracted over $20 billion since launch, and Harvard's participation will give more institutional investors confidence to enter. I think the significance isn't about the 1.16 billion figure. It's about the signal. When the world's top university funds are buying Bitcoin, they're telling everyone that cryptocurrency is now a mainstream asset, no longer a fringe investment. The third news is about the EU. The European Banking Authority released the final technical standards for banks tokenizing traditional assets. This might sound technical, but the impact is huge. Simply put, EU banks can now process tokenized securities on any type of blockchain network without bearing additional capital requirements. You know what this means? Banks in other regions following Basel Committee guidelines need to bear risk weights up to 1,250% for holding similar assets on permissionless networks. 1,250%. Folks, basically telling you don't touch it. But EU banks can now explore freely. That's a massive competitive advantage. How big is the tokenization market? It's expected to reach $5 trillion globally by 2030. 5 trillion friends, and the EU now has first mover advantage. Think about it: real estate tokenization, letting small investors participate in high-value property investments. Corporate bond tokenization, dramatically improving financing efficiency. Art and collectibles tokenization, creating entirely new investment methods. What I find most impressive is this will make Europe the global innovation center for tokenized finance. Within the next 2 years, Europe will definitely see a surge of tokenization platforms and fintech companies. Global capital and talent will flow there. Plus, this will strengthen the euro's international competitiveness. This is a really smart move. Of course, to fully leverage this advantage, supporting measures are needed. Consumer protection, cross-border enforcement, integration with traditional financial systems all need to keep up. The EU says they will have a complete tokenized finance regulatory framework by the end of 2025. I think that's worth looking forward to. The fourth news. Trump signed the Genius Act, America's first major cryptocurrency legislation. This bill passed the House 308 to 122, Senate 68 to 30. This kind of bipartisan support is really rare. What does Genius stand for? Guiding establishment of national innovation in US stablecoins. You can tell from the name it's ambitious. This act establishes a clear federal regulatory framework for the $250 billion stablecoin market. The core requirements are strict. Stablecoin issuers must have 100% backing with US dollar cash or short-term US treasuries, monthly public disclosure of reserve composition, and compliance with anti-money laundering and sanctions requirements, basically making stablecoins as safe and reliable as bank deposits. The market reaction was incredibly positive. Circle, USDC's issuer, saw its stock rise 15% within 24 hours of the bill being signed. Coinbase, Kraken, and other exchanges also saw gains. More importantly, traditional financial giants like JP Morgan Chase, Bank of America, Wells Fargo all stated they're considering launching their own stablecoins. What I find most impressive about this act is it gives the US dominance in setting global stablecoin regulatory standards. US dollar stablecoins already account for over 95% of the global market, and this new act will further cement that advantage. Other countries will definitely reference US standards when making their own regulations. That's soft power right there. Analysts predict after implementation, the US stablecoin market could double to $500 billion within 2 years. 500 billion. And these stablecoins can be used for cross-border payments, smart contracts, DeFi protocols, and various other scenarios. This will spark a new wave of fintech entrepreneurship. Of course, there are implementation challenges. Regulators need to draft detailed rules. The industry needs to adapt to new compliance requirements. International coordination needs to advance. But regardless, the Genius Act establishes America's leadership position in global digital currency. That's undeniable. The fifth news is particularly interesting. The AI agents sector suddenly exploded, with market cap surging from almost zero to $14 billion. Virtual's protocol, AI16Z, Griffin are leading the pack. Honestly, I didn't quite get it at first, but after researching, this thing could really be a game changer. What are AI agents? Simply put, they are smart programs that can autonomously execute DeFi operations without you worrying about it. They can analyze market data in real time, find arbitrage opportunities, automatically execute trading strategies, optimize yield farming configurations, even manage cross-chain assets. You just tell it your investment goals and risk preferences, and it works 24/7 making money for you. What I find most impressive is the business model. After developers create high-quality trading strategy agents, when other users use that strategy, creators get a share of trading fees. I heard the top AI agent creators are already making over $1 million monthly. $1 million, folks. That's more than many fund managers make. From a technical perspective, this combines machine learning, large language models, blockchain, DeFi, all cutting-edge tech. The latest AI agents can understand the natural language. You tell it, help me maximize returns while maintaining 50% safety, and it automatically parses the requirements and executes strategies. This is so user-friendly for beginners. DeFi used to have such high barriers. Now even newbies can play. VCs have already smelled opportunity. i16's Paradigm, Sequoia, and other top firms have invested over $500 million. They think this isn't just technical innovation, but a fundamental transformation of financial services. I personally think this sector has huge potential too. Of course, there are risks. AI agents' decision, transparency, system security, regulatory, compliance all need improvement. Performance under extreme market conditions hasn't been fully tested. But analysts predict market cap could reach 50 billion by end of 2025, potentially exceeding 200 billion by 2030. This growth potential is really tempting. The last piece of news is pretty brutal. The global crypto market experienced a $900 million liquidation storm in the past 24 hours. 900 million and 82.3% of that, or $8.23 billion, were long positions getting liquidated. This is the second highest single-day liquidation amount since 2025 began. Honestly, when I saw this data, I gasped. The trigger was the Trump administration's announcement of new global tariff policies. 41% tariffs on Chinese goods, 10 to 20% on EU, 25% on Mexico and Canada. Once this news hit, global inflation fears exploded. US 10-year Treasury yields spiked 30 basis points. Risk assets crashed across the board. Bitcoin dropped from nearly $120,000 to $113,400, down 5.6%. Ethereum was worse, falling from 4,000 to 35.18, down 10.5%. XRP, Solana, Cardano, and other altcoins all dropped over 10%. The entire market lost over 200 billion in market cap. Looking at the liquidation data, high leverage traders got hit hardest. Binance, OKX, Bybit, and other major derivatives exchanges accounted for over 85% of liquidations. 5 to 10 times leverage traders made up 60% of total liquidations, showing even moderate leverage investors couldn't escape. The market's very divided now. Pessimists think tariff policies will keep pushing inflation higher. The Fed might be forced to adjust monetary policy, continuing pressure on risk assets. Technically, if Bitcoin loses the 110,000 support, it could drop to 80 to 90,000. but optimists think this is actually a buying opportunity. Mass liquidations cleared excessive leverage, reducing resistance for future rallies. Historical data shows liquidations of this scale often mark short-term bottoms. Plus, ETF inflows remain strong. Institutional investors' long-term confidence is unaffected. Personally, I think this liquidation exposed crypto's sensitivity to traditional financial risks. Under macro uncertainty, crypto acts more like a risk asset than a safe haven. Everyone needs to control leverage and manage risk properly. Alright folks, that's it for today. The market's like this. Some people are celebrating Ethereum breaking 4,200. Others are getting liquidated and forced out. I think this market never lacks opportunities. What's lacking is patience and risk management. Short term, the market does face quite a few challenges. Tariff policies, Fed moves, geopolitics. These are all variables. But long term, regulation is improving. Institutions are entering. Technology is innovating. Fundamentals are actually getting better. Remember, bull markets don't go straight up. There's always pullbacks. The key is whether you can hold on, whether you can stay calm when others panic. Control your positions. Don't use too much leverage. Keeping some dry powder is never wrong. See you same time tomorrow. Wish everyone successful trading. Remember to like and subscribe. Bye!